Hello, everybody. This is Alex Fensky, the lead agent for the Chicago Southland Homes team with Keller Williams Elite here in the south suburbs of Chicago. If you have questions about anything that I cover here today, feel free to leave a comment, send a message, give me a phone call, send a carrier pigeon, whatever it is that floats your boat. I am going to go through the December housing market update. And as always, there's going to be some stuff that you probably are not so surprised to hear, some stuff that you are surprised to hear, some things that are stable, some things that have changed. It's always unpredictable. That's why I do it. So I am going to get started here with talking about some seller metrics in the market and what they mean. And then we're going to talk about some buyer side stuff, demand. We're going to talk about how those two things are interacting, where prices and mortgage rates are at and where they're headed, and then what the heck to do about it. Now, remember, I can only give you general advice, and even all the stuff I'm going through here is actually quite general. It's more specific than what you hear on the news, which is nationwide, but it's still for all of northeastern Illinois. And there are a lot of different markets that are behaving very differently, even inside that region. So I guess the end point of all that is if you're actually going to do something and it's actually going to affect your home, your money, whatever, call me. Don't rely on some recorded market report. I'll give you a customized one for your situation. Let's get started with some supply metrics. So number one, first point is there were fewer homes listed in November of 22 than any other November as far back as my data goes. You can see here that this data goes back to 2008. It's been 14 years. There's not been any other November where fewer homes were put onto the market. And that number is down 19% compared to November of last year, which was low already. So the number of new listings coming on the market is extremely low. It is at record lows. And thank God it is, because demand has dropped off quite a bit, primarily due to the affordability index. So housing affordability is calculated when you take a look at what are home prices, what are mortgage rates, and what are wages. So over time, as these things change, people's wages go up, mortgage rates fluctuate, home prices fluctuate, and the math as they all combine dictates what it feels like to buy a home. And there's areas and there's times where it feels like you're getting a great deal, and there's areas and times where it feels like I can't make any sense of this. So we're going to revisit that topic in a couple of minutes here. But housing affordability is primarily what has driven the drop-off in demand. And that drop-off is about 30%, a little bit higher than 30% when you look at the number of contracts that are pending and the number of sales that closed in the last month. Those numbers were down about 31, 32% compared to November last year, and they're at their lowest levels in about 7 years. If it were not for the severely limited supply that I just talked about, that would be causing what feels like a crash in the market. Because of the severely limited supply, it's nowhere near a crash. It's just that both things have dropped off rather suddenly, and we haven't seen circumstances quite like this before. Months of housing supply is a metric we use to ascertain what is the relationship between how many sellers and how many buyers there are. And that's important because that'll tell you how it feels like to participate in the market. Who does it feel like has the upper hand, sellers or buyers? And this is a bit weird. Months of supply tells us how many months would it take to sell off all the active listings at the current pace of sales. And about 5 to 7 months is balanced market. Fewer than 5 months, or faster than 5 months, if you want to call it that, is a seller's market. Anything more than 6 or 7 months is a buyer's market. Supply last month was at 2 months and went down to 1.9. Now, seasonally, that's normal. It always dips heading into the winter. But that's the second lowest November supply behind only 2021. So it's a very firm seller's market. And there's some things that should be causing like wicked price increases that it's not. But nevertheless, the numbers do not lie. It is a seller's market, in fact, which just means that there's more buyers than there are homes available. The median number of days to contract from the time a home is listed to the time it went under contract Single month went from 13 days in October all the way up to still 13 days in November. It didn't change. The 12-month rolling average, which eliminates seasonal changes, stayed flat at 9 days. It's been 9 days since September 21. It's been 15 months that the days on market, which is going to be listing to contract right here, it's been 15 months that number has essentially not changed. There was a couple of months where it actually went down to 8 days, but we're rounding between 8 and 9. So you're talking about a change that would be tough to feel. Let's turn this back to, there you go. Look at this, 9 days, 8888999. That's the market time. Listing to contract hasn't changed. So those things tell us that the balance of the market is still to sellers. That should be causing rapid price increases because typically the number one way that a buyer competes for a listing is to offer a higher price. But the cost of money has gone up so much, and the cost of everything else that buyers have to buy to live because of inflation has gone up so much. And the cost of the homes has gone up so much. People are trying to find anything except price to negotiate on. Higher earnest money, buying it as is, short closing, long closing, post-closing possession. Whatever it is that you can dream up, just anything but price is basically what it's coming down to. And so because of that, for the first time, monthly pricing, meaning November's closed sale prices, were actually lower than last November by 1.8%. It's the first time we've seen a year-over-year drop in pricing since 2012. And it's nothing to be scared about. It's not a big difference from being flat, or a little up. But it's something that is notable. So if you go back 10 years, here's how the curve looks. We've been basically going up every year since 2012. And so now they went down a little bit. Take a 12-month rolling average, and it's been flat for 4 months straight, maybe 5 if you factor in a little bit of wiggle room. So our seasonalized pricing has been flat now for 4 to 5 months, despite the seller's market. That's just how it is. Don't ask me to explain it, but again, because of affordability concerns, people are just negotiating on anything except price. Important to note, many of the major research institutions, which are trustworthy and reliable, I'm talking Fannie Mae and entities like that, have recently adjusted their forecasts for pricing in 2023 and gone from saying they're going to be up a little bit to now they're going to be down a little bit. That may well happen here as well. We're seeing a little bit of it now. But the key factor here is that housing affordability is more favorable in the Midwest than it is in all the other regions in the country. And so our prices, as it relates to our wage growth, did not get anywhere near as far out of whack as most of the other areas of the country, particularly the West Coast, which is way out of line. And so when you think about the correction that happens, it's either going to be just a nice, friendly old Midwestern correction or like California style wicked volatility. I was looking at one of the reports I looked at here this morning, ranked the top 10 housing markets that will hold up best through this market change. And 3 of the top 6 areas were in the Chicagoland area. So that tells you something. I'm not casting fear out there. This seems like probably a needed market correction and nothing super scary for our buyers and sellers. Mortgage rates, if you have been shopping right now, you should be locking right now. Shop, drop, and lock it, something like that. Today's 30-year fixed rate is 6.29%, down nearly a full point from its peak, which was just a little over a month ago, October 31st. Median 30-year fix was about 7.2%. We're down to 6.29. Government loans, FHA and VA, are about a half point below that, so down into the 5s. How you like them apples? The Fed is probably going to taper back their rate increases. They're going to keep doing rate increases, but smaller. They're expected to raise their federal funds target rate by a half a percent, aka 50 basis points in December instead of 75, which has been their last several increases. But this is still going to be volatile because anytime you hear another jobs report, another inflation report, another Federal Reserve announcement, the markets are going to swing. And so just pay attention if you're shopping, pay attention to what your lender is telling you, whether they're expecting rates to go up, down, if today's a lock day, if today's a float day, listen to your lender. If you don't have one yet, talk to us. We got some great people that stay on top of this stuff. So what do you do about it? Well, in summary, it is a strange world where we have a seller's market and prices are flat. Never expected I would see that, but it is the truth. For sellers, you need to price aggressively and continue to put a lot of energy into staging and preparing the home for market. We can help with that. We always do consultation. We urge you to take that advice and get the home ready. For buyers, it's nice for you that prices have flattened out. Unfortunately for you, mortgage rates are wildly volatile right now, and they're all over the place. And that's the biggest thing for you to pay attention to right now. This moment, as I record this, is probably a good time to lock. There is going to be more up and down after this. Take a look at non-conventional loan products. It's been 10 years, and all anyone's been writing is a 30-year fixed rate mortgage. But there are other things out there. You can buy down that rate. You can ask for seller credits to buy down that rate. You can look at a 5-1 ARM, a 7-1 ARM. You can even do an assumable loan. If the seller's loan is assumable, under the right circumstances, you can actually take that mortgage from them out of their name and keep their 2.75% that they got a couple years ago. So talk to us about how to do assumable mortgages, and we can help you with that. And most of all, call me for any specific guidance for what you're doing. I'll be happy to help you out, tell you what supply's looking like in your area, give you a market analysis on your home, quote you some payment estimates or whatever it may be. All my contact information is on the page here. Comment below, shoot me a message. Hopefully this is helpful for you. Feel free to share it, and we'll see you next month in the new year when we give the full 2022 end of year housing market update in January. Have a great day, everybody.